Good morning, everybody. Hopefully you had a wonderful weekend. We had finally a good spring weekend here, so we are all in good moods. So last week, 5Q tape breakdown. I love this guy. He's going for the motive, not once but several times to get them to say it. And by the way, this is fantastic tape to listen to if you ever run into bond funds. And guys, right now, if you've got clients in bond funds, should you be talking to your clients? If you've got clients in bond funds or you have prospects in bond funds, how quickly should you get to them? It's probably, right now is probably too late. But right now, better late than never, right? So please take a listen to this, because this shows you that when you do the 20, we talked about the 21-point checklist last week. If you do the 21-point checklist right, you can go back and get them to say what you want them to say if you get on their side after each time. Make sense? And I do want to bring this up. The likelihood and cost of long-term care may be higher than you think. It's probably not higher than you think, but it's certainly higher than who thinks, our clients. So the likelihood of needing long-term care for 65-year-old individuals and male-female couples. So likelihood of individuals is 44%. Likelihood of for women, 56%. Likelihood of male-female couples, man only 19, woman only 31, both 25, one or both 75. So if you've got a couple, guys, what's the chance one of them is going to need long-term care? Everybody answer this. If you have a couple, what's the chance of, because really, if you think about it, an individual, if they need long-term care, they're going to spend all their money and then the state will pick it up. But this is the danger one, right? Obviously we're not going to get the kind of care we'd want, but at least it's not terrible if we go on Medicaid. But here, if a couple goes on Medicaid, or one of the person goes on Medicaid, if they go on Medicaid, that other person's got to be what? Broke. So is that how you want to leave your spouse? Broke because you're in a long-term care facility or you need long-term care in the home. So have you all discussed with ECA any products that they have for addressing this long-term care? Because how many people want to pay expensive annual premiums for long-term care? None. But will they at least listen to other options? So make sure you're talking to your clients about this, and also make sure you're talking to ECA about this. Make sense? So speaking of ECA, every cloud has a silver lining. So right now, we've got inflation through the roof. But there is a silver lining to that. So what is it? So Jerry, what is the silver lining to inflation being through the roof?
Well, the silver lining, guys, welcome, good morning, is rates are going through the roof. And I got to tell you, it's pretty exciting. It's been a while. Right now has been one of the funnest times in the last handful of years here because rates have been going up exponentially. It's fun. The days of rates going down and you guys calling in and us making sure that we're getting applications in time, those are kind of done right now, but rates have been flying through the roof now. And I just wanted to give an update, and thanks for having me on the call, Mike, to let you all know. If you hadn't noticed, pretty much every carrier, I feel like on a weekly basis, we're getting a notice or an update from someone telling us that rates are going up. And I do expect to see as it continue as rates continue to rise here too as well. So I just wanted to highlight a couple products that you guys may not be noticed or may not be using that I think are pretty darn good products, and just want to let you know where the rates were with some of those. Just kind of, I'm not going to do something overly in depth, but just wanted you guys to be aware of some of the indexes out there that are getting some significant rate changes. And I don't know if you guys can see this very well, but on my screen here, kind of the first one I wanted to talk to you guys about quickly here was Equitrust. So Equitrust, awesome company. They have, some of the best service out there, and they're really aggressive when it comes to their rates. And you have a product that's got 10% free withdrawals too. So what you guys are looking at on your screen right now is the Equitrust Market Value Index product. If you haven't used it before, it's a 10-year FIA. I kind of look at it as a growth product. All of you guys who know me and talk to me know I kind of like to categorize products. You got your income rider products, and then you have your true bond alternative asset allocation products, and the market value is that. And as you can see here, They're probably due to have one here. They had 2 rate changes, I believe, in April, and I bet they're probably coming up on maybe having another one. But the Barclays Focus 50 here at the top, 120% participation. Back in March, that was at 90, so it's had a significant increase. The S&P cap right here in the middle, so S&P 500 cap, we're at a 6% cap rate on that. I mean, that's pretty exciting. I mean, it's been probably 3-4 years. I want to say probably 5 months ago, our S&P caps 4.5 was really good. So the fact that we're all the way up at 6% right now, that's really exciting. Now, I don't like to lose sight of the fact that ultimately, guys, FIAs, the goal of it is to have something that doesn't lose money, but it isn't half bad if you can make some money while you're at it. But then we have the 2-year. You know, a lot of us talk about the strategy where you it's kind of the leapfrog method where you blend a 1-year and a 2-year point to point together. You got the Barclays Focus 50 year and a 2-year point to point at 150% participation, so you can get a little bit more leverage there. So I kind of like to do a blend between that 1 and the 2-year. That way, if you do a blend, you're getting crediting on an annual basis. And then every other year, you got the 2-year coming due to give you a little more leverage. We can always talk. If you guys have questions on, you know, the leapfrog method and how you do that, you can always give me a call and we can go over that later. I just wanted to just mention that while we're on here. But in short, market value index, they're having some great rate increases here. It's a 10% free withdrawal. Wanted you guys to have note of that. I'm going to go to a couple other products here that I think you guys can jot down. Here's one I'm going to click on. This is American Equity, our good friends American Equity. They have the Asset Shield series, in particular, the Asset Shield 10. Kind of take note here. And if you aren't familiar with some of these products, the Asset Shield 10, and you want more info, give Matt a call after the call, give myself a call, give Dan Wilkie a call, or just shoot us an email and you can request some information. The Asset Shield 10, they just did rate changes. This is, again, another 10-year growth product. 10% free withdrawal from A- rated American Equity. They just did rate changes on May the 10th. Pretty significant changes too. What they're kind of known for is they have their Bank of America index here on the top, and then you have the Credit Suisse Tech Edge, that CS Tech Edge, kind of a tech-related index, and then they have their SG Global Sentiment down here on the bottom. But I'll just focus on the top here. They made changes. You can get their indexes in a 1-year point-to-point or a 2-year point-to-point. So you can kind of do that leapfrog method I talked about if you want. And they also have a unique feature. And I talked about this product, I want to say back in October, where you can add a fee to the index if you want to get higher participation rates, which means potentially higher returns. And just to give you a little idea here, so let's look here in the Credit Suisse Tech Edge area here, right here, kind of in the middle, CS Tech Edge. The 1-year point-to-point right here with no fee is 110% participation. And this is up from about 85% where it was at. So another significant increase. You can add a fee of 1.5% to it right here, right below it, and it boosts it up from 110 par to 180. That's pretty significant. And if we want to jump to the 2-year point-to-point, it's right here, just right above the 1. You can do the 2-year with participation rate, no fees on it. It's 165% participation rate. You can add the fee on it. It boosts it up to 265. So you get a really significant increase by adding a fee there if you want to do that. But most importantly, these rates have probably gone up 30 to 35%. So if you've been using the American Equity Asset Shield or you've used it in the past, maybe you want to take a look at it again because they had some significant increases here on May the 10th on pretty much all their indexes here across the board. They even have a fixed rate built in at 2.45%. So one of the little sayings I always like to say, you guys may be running into, is and I don't want to take too much time here. I got a couple more products I want to look at, but I mean, it is I'll get into that a little bit later, but it's a great time for index annuities, especially with rates going up. I'm going to flip to another product here, one that we all know pretty well, and then I'm going to surprise you guys with a new one that you guys probably haven't been paying attention to because they haven't been really. They haven't really been.
Jerry.
Yeah.
Don't feel like you need to rush. So if you got something you want to say it, okay?
Okay, I got a point I'm going to make at the end here. So the Silac Denali, all of us know this product. A lot of us used it. We love it. They do a lot of really great things here. They just did a rate change on May the 2nd. So if you hadn't taken note, they just had one. And some of the exciting stuff, you guys all know why I like this product. I mean, you have great volatility control indexes, and then you have really good S&P, some of the best S&P rates that are out there. So our Barclays, who they're pretty known for, the Barclays Atlas 5, it's at 120% participation, no cap. That's up from, they didn't do a huge increase on that because they're already really really competitive, but they're up from about 115 to 120, and the Credit Suisse went up from I think 115 to 125. But right down here at the bottom, S&P 500 annual point to point with participation rate, 40% participation rate. That's one of the highest, if not the highest, no fee annual point to point participation rates out there. So if you're someone who likes to have that, completely correlated with the market participation rate, you want it on the annual point to point, Denali from Silac's probably where you want to look. And then a cap of 5.75 is really strong. And then if you play with the monthly point to point, 2.25, I think that's probably your highest S&P 2.25 index out there on a monthly point to point. So what I like to do, and why I kind of like Silac products, is I do like to blend their vol controls like the Barclays, the Credit Suisse, and the S&P 500 together. That way I get a touch of each. I know sometimes when you have volatile markets with the volatility control indexes, you can have some lower returns in those vol control indexes. So if you blend some of the S&P in there, I'll give you an example. Last year was one of those years where there was a lot of volatility in the market, but there's some nice returns in the S&P. Some of these vol controls had a little lower return, and that bothered some people. Blend in a little S&P with your vol controls, and that'll help kind of smooth some of that out and get you guys some return when that happens. So Denali just did their rate change in May. If you haven't been using it, if you like S&P par rates, if you want a really good volatility control index, they have everything on 1 year point to point. So it makes it really simple and easy, annual reset, just a simple deal. And if you don't know, it's a 5% free withdrawal. So it is a little bit less of a free withdrawal than some of the products. And then kind of flipping over here, kind of a surprise one we haven't heard in a while. I know some of you guys have used it, and if you haven't heard of this, use this product or know about it, you may want to pay attention. And it's Lincoln, so a pretty well-known product. Lincoln, they're known. They got their 5-year, their 7-year, and their 10-year. I'm specifically pulling up the 10-year version of the product, but Lincoln A+ rated, really well-known company. Most people I think know what Lincoln is. They got a Lincoln Financial Field out there in Philadelphia. So if you're a football fan, they kind of sponsor that, so they kind of gotten their name out there. But they decided that they want to jump back into the annuity game. Lincoln has. They've been kind of non-competitive. A lot of it is kind of treasury related and kind of bond related, some of those rates that they could get out there, but they haven't been competitive since probably pre-2020. But they're back in it. They're ready. They're being really aggressive. They have their rate changes going in effect tomorrow. So 5/17. You guys are ahead of the game here. You get to hear about it. They got rate changes coming out on May 17th tomorrow, and they are pretty darn significant. This is their 100 plus band right here. So 100,000 plus band. They have their 1 year BlackRock index. It's got it's a fee base. If you want the fee based version, 1% fee is going from 175 par to 200% participation. I think if you look at the 10-year return on it, you're in that 7, 8, 9% range, like a lot of the fee based indexes were over the last 10 years. The 1 year BlackRock without a fee on it is jumping from 130 to 155. Their Fidelity, here's a huge move. Their Fidelity dividend index, this actually has dividends in it, is going from 65% participation rate with no cap all the way to 150%. So they're going from being, a kind of a non-factor to really a significant carrier to be able to use. 50 basis point spread on their S&P daily risk control down to a 1/4 point. And then, this is significant. I was just talking about a high par rate right here. I guess Lincoln's right there too. They're going from 35% to 40. And then this is out of this world right here. I wasn't sure if we'd ever see this again, but they're going from a 5.65 S&P annual point-to-point cap all the way to a 7% annual point-to-point cap. That blows my mind because I don't know if I know it's probably had been 8 years since I've seen a product on a 10-year chassis that has a 7% cap. And then kind of rolling it back here to a the 2-year BlackRock, 170 par up to 200% par. And this is a right here 2.5% fixed rate. This is a product that has 10% free withdrawals and 10% free withdrawals available in the first year as well. So it's a competitive growth product. If you guys are looking for something, need something that's highly A rated, very competitive. I think Lincoln's someone that we should be looking at again. I wouldn't have said that 2 years ago or a year and a half, or probably, quite frankly, even 6 months ago. But they're a competitive team. We got a good relationship with them. I think they have a smart back office team. You know, if you have some advanced case things that you need to do, if you guys do non-qualified stretches, if you ever run into one of those, so basically an inherited non-qualified annuity, Lincoln is one of 3 carriers that take those as well. So they're a good fit in that space. But one of the points I wanted to make too as well is here's something from time to time that comes up, just a little tidbit. I'm sure Mike can agree on this too. Every now and then, like it's exciting. We have rates are going up. That's really cool. And sometimes I have annuity guys that are like, oh, you know, markets are a little shaky. It's nice to be able to have some good options and things to be able to give some people some reprieve. The funny little thing that I run into, and I like you guys to be aware of too as well, sometimes in marketplaces like this, you'll have clients, you're like, oh, this is gonna be great, you know, and you'll have clients where they're like, oh, well, the market's down a little bit, and so maybe maybe I should wait until it comes back up. You know, we need to wait until it comes back up a little bit. And here's what I can help you out with a way to be able to combat that, because that's an issue too as well for a number of different reasons. And you may run into that when the markets are a little shaky. You may have some people that say, well, I can't do it because now, you know, I'm down too much. I don't want to lock in those losses. Well, here's the great thing about fixed index annuities. And we have there's a little presentation. I think it's in the we used to I'm sure we have it on the website somewhere, but this is where I always tell guys fixed index annuities are always good. There's never a bad time for annuities. And you can kind of walk a client through and say, hey, you know, when the markets are good, is the market a good place? Yeah, it is. You know, if markets are good, are annuities a good place? Yeah, because annuities are going to participate and they're going to get part of that upside. It's a good place to be there too as well. Well, and if the markets are flat, are annuities a good place? Yeah, I mean, we're not paying fees typically on them. And that's fine. You know, if we're in our managed money, you typically don't want it because a lot of times we have a little bit of fees. Now, if the markets are down, is the market a good place to be? Everyone's going to agree, no, it's not a great place to be. Are annuities a good place to be? Yeah, because we don't lose any money. So which one of these, all 3 of these market conditions, which one is okay in all of those spots? And the only one is the fixed index annuity. So that's something to remember if you run into that type of a remark or thing that comes out there, is we don't need to wait. If the market ends up going down a little bit and you get someone's like nervous, hey, it might come up, and they want to try and time it and hope for it to happen. The great thing is with your fixed index annuity, we don't have to take that chance that it might go up, and so I want to lock in a higher number. Now, the moral of that story is the right time is right now. So I just like to get that out there so you guys can have that little story in the back of your pocket that, you know, it's never a bad time. We don't have to wait to time the market. The beauty of the fixed index annuity is we're going to participate when it goes up. So we don't have to wait for it to go up. And even more important, if we have it in there, if we guess wrong and ends up going down, we're not going to lose any money. And a lot of you guys know that, but that's just something to remember sometimes, because it makes sense in our own heads when we want to tell clients, yeah, when they say, hey, maybe I should wait because it might go up, because maybe even you might believe, hey, I think the market's going to go back up, so maybe they're making some sense. But that's kind of, there's some false logic that's based in, especially when you have a tool that can prevent, and we should have our clients diversified and have some asset allocation anyway. So my main point here, hey guys, it's a great time. Rates are going up. It's an exciting environment. I think they're going to continue to go up, and there's some really good options here. So if you have any questions about these products at all, you're wondering about any other rate changes and things, feel free, reach out to myself, Dan, or Matt over at ECA, and we're happy to get you up to speed and even get you, if you want some rates and some information on these products, go ahead and give us a holler, and we're happy to help out. So any questions at all for me, Mike?
Let's see. Let's give him a minute to see here. But like you said,
sure, everybody's
territory is a little bit different, so it'd probably be best to call you if they have questions. But the couple of things we're going to emphasize here is, one is I'm going to, at the end of the call, I'm going to talk about why that 10% free withdrawal makes so much sense and they should pay attention to. So, guys, this is an exciting time. Like Jerry said, we haven't seen anything like this for half a decade or more. So please be taking advantage of it. So, and then I'm going to kind of show, Jerry mentioned, so I brought up, I think, what Jerry was talking about. So when we turn the screen back over me, I will go there. Thank you, Jerry.
Yeah, you bet. Thanks, guys.
So Ben asked, will the forward participation rate FI presentation work again? Absolutely, and that's actually what I have up right now, Ben. So this is just one slide from the presentation. I'm not going to go through the whole script because it takes about 7-8 minutes, but we talk about, there's 3 places you can put your money: safe money, safe place, marketplace, or Warren Buffett strategy. So if the market goes up, is a safe place a good place to be? Oh, I'm sorry, there's 3 things that the market do: up, down, or sideways. So the market goes up, is a safe place to be? No. Is the market a good place to be? Yes. Is Warren Buffett a good place to be? Yes. The market goes down, is a safe place to be? Yes. Market a good place to be when the market goes down? No. Warren Buffett a good place to be? Yes, because it buys low, sells high. If the market goes sideways, is a safe investment a good place to be? Yes. Here's a question, guys: if the market goes sideways, is a market investment an okay place to be? Everybody answer yes or no. The market goes sideways, is a marketplace a good place to be? Everybody's saying no, exactly right, because you still have to pay what? Fees. Yeah. Is Warren Buffett a good place to be? Yes. So you're right. If things are, regardless of what happens, a safe investment is right two-thirds of the time. A market investment is right 1 out of 3 times, and the Warren Buffett strategy is worth how many times? 3 out of 3. And here's the thing, guys. Where's the best place to be if the market goes up? Well, obviously the market does. Well, the second place is Warren Buffett. Third is safe. Market goes down, the best place to be is safe. Then Warren Buffett, then the market. Market goes sideways, the best place to be safe, Warren Buffett, market. So why would we then ever want, you ask a client this, when you do this, client, then why would we ever want to be in second place? Why wouldn't we want to be in the first place? Why wouldn't we want to be in the number ones? Why do we want to be in the number twos? Because this is what? Mistake proof. Can you ever make sure you're at the right place at the right time? Can you be at that convenience store to win at the right time so that the lottery ticket spews out the winning lottery ticket? Can you make sure you're at the right place at the right time ever? So everybody answer that. Of course not, you can't. But can you make sure you're never at the wrong place at the wrong time? So if my son says, I got mugged last night, I said, whoa, what happened? He goes, well, it's 2 o'clock in the morning. Well, first of all, nothing good happens after 2 a.m., right? 2 o'clock in the morning, and I was in the party district, and I was looking at my phone. What am I going to tell him? Dude, whose fault is it? I mean, whose fault is it that he got mugged if he's at 2 a.m. in the middle of the party district looking at his phone instead of paying attention to what's going on around him? So you can avoid being at the wrong place at the wrong time, but you can't be at the right place at the right time. And with the Warren Buffett strategy, that's what we do, right? So if you haven't looked at the 40% or the participation rate presentation on the website for FIAs, you should make sure you do that. Okay. So the next thing I want to talk about is this: is that what's going on? This is a little caption from a text conversation. What's going on with the stock market? LMIO, laugh my ass off. Don't worry about it, babe. Okay. Yay. So how many of these conversations are going on right now with this being their advisor? How many advisors are saying, hey, don't worry about it, it's just a blip, it'll come back? Most or very few? Most. And how does a client feel when you call them up and this is happening to their 401k or their retirement plans, and you say, hey, don't worry about it. The market goes up and down. It always goes back. Just don't worry about it. What do they think? You care or do not care about them? That you do not care about them. So you have to be an effective client communicator. So I'm going to give you a whole bunch of information today that will help you do that so you can communicate well with your client. And then I'm going to give you a solution to all these things at the very end. So this is from MarketWatch. Based on a 19 bear markets in the last 140 years, here's what the current downturn, when the current downturn may end, says Bank of America. So right now, just $3 for every $100 has left the marketplace. Is that a lot or not? Does that mean that we're at the beginning or the end of a bear market if only $3 is left? Two right answers. Come on, everybody, answer this. In order for there to be a bear market, how many people have to have left the market? A few or big chunks? Big chunks. And is that the case at this point? Not even close. So according to Bank of America, it's widely followed definition. Bear market occurs when a market or security is down 20% or more from a recent high. The S&P 500 has been skirting ever closer, dropping below the 4,000 on Monday, and that was about a week ago, close to a week ago. To bring it at 16.8% from a January all-time high of 47.96. The correction territory is often defined as 10% from recent highs. So we're obviously in a correction, but are we in a bear market? Not yet. The battered NASDAQ, meanwhile, is down 27% from the November 21st high. But should the S&P 500 officially enter the bear's lair, I'm going to go back to the NASDAQ once. Does the NASDAQ generally recover faster or slower than the S&P 500? Does the NASDAQ generally recover faster or slower? No. Everybody's saying faster. It's slower. It's slower. How long did it take for the NASDAQ in the 2000? How long? Go look at 2000 and see how long it took for the S&P 500 to get back to ground even versus the NASDAQ. So you need, yes. See that? So there's something that many people have a fallacy of. They think, hey, if it goes down fast, it's gonna what? Come up fast. But should the S&P 500 officially enter the bear's lair, Bank of America strategist led by Michael Hartnett has calculated just how long the pain could last. Looking at a history of 19 bear markets over the past 140 years, they found the average price decline was 37%. Are we anywhere near the average? And think about this. How much overvalued are we right now? In January, how much overvalued were we? We were at 1965 overvaluations. We were at the same valuation in 1965, same valuation in 2000, same valuation in 2008. We're extremely overvalued. So do you think if we were extremely overvalued, I mean, matching or breaking the records for other overextended markets, should we go down more or less than the average? We should go down more than the average. And so, but even if we go down the average, are we anywhere near the bottom of this thing yet? No. So if you ever want to see how long it takes to get back, I mean, they'll show you the trough, the decline, 86%, 60%, 56%, 51, 49, 48, 36, 34, 33, 33, 30, 29, 28, 27, 22, 21, 21, 21, 20, 20. If we're an average, we're not anywhere near where we need to be before this bear market is done. Another one from MarketWatch. This Wall Street legend has lived through every bear market since the 1950s. He says the one coming should hit the S&P 500 30% loss. Bob Farrell, a 90-year-old retiree in Florida, is hardly a household name on Main Street, but in Wall Street, he's a legend. To say that Farrell has seen it all is an understatement. He witnessed every bull, bear, bubble market since 1957 when he joined Merrill Lynch as an analyst trainee and embarked on what became a 45-year career, including 25 years as their chief stock market analyst. Is he a doughhead or does he know what he's talking about? In April, he said he expects investors in the U.S. stock indexes could be mauled 30% loss or more, and downward pressure on share prices could last all the way through summer. He advised selling into rallies rather than buying on dips. What is the retail investor doing right now? Are they selling into rallies and buying on dips? Are they selling into rallies or are they buying on dips? The retail investors, they're buying, right? Otherwise, sheltering in value stocks. We are in a bear market, and this guy has 8 rules for bear markets. I think it's a fantastic read. If you can go here and read this article, it's awesome. Growth tech is going to go out of favor. We're gradually breaking down the big cap stocks that have kept the S&P 500 up. By the time this is over, it's likely that they'll go into a larger decline, and if the S&P 500 becomes 30%, which I think is a possibility, then you'd be down to 3460 on the actual return, or I'm sorry, on the actual value. S&P 500 was down 17% from the close when it hit the high on January 3rd. To Farrell, the market's current downturn is a natural consequence of exuberant bull run that is fueled by easy money, excessive speculation. Guys, we've talked about this how many times over the last 5 years? What caused the market to go up? Profitability from the companies, or the fact that they could borrow at zero and they were buying back their shares? Who's buying back their shares right now, guys? Can they borrow for free and buy back their shares? Can any of these companies do that anymore? And the longer that trend persists, and we're paying the price right now with inflation, right? Did the Treasury wait way too long to rein in this easy money where they're printing money in 0% interest rates? So there's no new eras. Excesses are never permanent. That's why investors buy most of an asset, like stocks or bonds, at the peak prices and the least at troughs. The pendulum swings too far one way, guess what it's going to do? Swing too far the other way. Concentrated ownership is a cyclical measure of vulnerability to future potential. Similar concentrations occurred in 70-72 when the Nifty 50 were dominant. What happened to the Nifty 50, guys? How many of the Nifty 50 are even considered a growth stock or even a good stock to be in at this point? None. So when all the experts and forecasts agree, something else is going to happen. Stock market bottom checklist goes, there's still a long way to go. So I want to look at, here's their market bottom checklist. So how many of their market are, whether we're at a market bottom, how many of them are stating that we're at a market bottom? Of all these indicators, and again, Oppenheimer is a bearish type entity. It likes you to have money in the bank and bonds. Oppenheimer is what? Promotes what? Stocks. And what are they saying? Are we anywhere near a bottom at this point? Now, only one, which is the volatility indicator. That's it. Goldman Sachs and the rest of Wall Street are souring on the S&P 500. But here's the thing. So can we agree there's a lot of big-time institutional investors that are saying what? The market is a good place to be or dangerous as heck right now? The institutional investors. They're saying it's a dangerous place to be right now. But what's keeping the market up? Oops. What's keeping the markets up right now? Small-time traders finally souring the market. Really? How many dollars have left the market? What do we say? Out of 100, how many dollars have left the market? 3. So have small-time traders really soured on the market yet? No. So tracking industry-wide data, Morgan Stanley found that small-time investors snapped up 14 billion stocks last month. Does that sound like they're souring on the market if they snapped up 14 billion? Nope. The behavior of small-time investors is being watched on Wall Street for signs of cathartic selling that many say would be a signal of the downdraft has reached its peak. Individuals haven't given in so far. So, guys, only $3 for 100 and 100 is left. Have the small-time investors given up yet? Are they still buying in the market going down? They're still buying when the market goes down. The bad days are starting to pile up in the resolve of many retail army. Because really, the retail army, how many of these guys have experienced a down market in the last dozen years? None. Because there hasn't been a down market in the last dozen years, except for the 3-month blip. Small-time traders who jumped in when the lockdown began have now given back all of their profits since the start of 2020. So they thought they were a genius for getting in, right? They thought they were a genius for getting in. And that downturn, what's happened to all those gains? Bye-bye. The month-long slump is sapping the dip buying spirit that ruled the market for 2 years. Professional money managers have already been raising cash. So institutional investors have known this for how many years? How long have I been telling you institutional investors have been piling up cash? I've been telling you that for a couple of years now. But the retail kept buying. People think a significant amount of selling still needs to happen, and they would rather wait for it to happen instead of stepping in. Most are referring to the retail investor and waiting for the shoe to drop. So they're waiting for what? The retail investor to leave. And when the retail investor leaves, do they leave in a trickle or in an avalanche? In a trickle or an avalanche? They leave in droves. So we've already talked about here. I mean, here's how long bear markets last. Sure, they can last. That one that we just saw here a couple years ago, 2 months. Is that typical? No. 3. But where are the rest? After you go through the 2 and the 3 and the 3, what did all the numbers jump to? What's the next biggest next number that's low? If I could say that right. What's the next low or next number after 2 and 3 months? 17 months, 22 months, 22 months, 36 months, 20. Guys, bear markets last for 2 and 3 months, or they last for what? Months and months. And that's what sucks the retail investors out. When the market goes down and then it goes up and they buy, it goes down further and then it goes and they buy and it goes up a little bit. Doggone it. And then so they buy when it goes 2 steps down, they buy, it goes 1 step up. Goes down 2 steps, they buy, it goes up 1 step. It goes down 2 steps, they buy, it goes up until eventually what? They're done. That's right, the dead cat bounce, exactly. So what should we be doing at this point? I refer back to Kitces and Wade Foe's unbelievable research on where we should have our money. And right now, this is today's stock allocation. So where is the best place for today's stock allocation? What percentage should we have in stocks today if we want to make sure that we never run out of money? So are your clients trying to make the most money possible or make sure they can live their lifestyle and never run out of money? They want to make sure, we've done this over and over and over, survey after survey. People want to make sure they don't run out of money. Well, that means it's the dark green. So where's the dark green on this chart? Where should they be on 0 in the market to 100% in the market to be in dark green in today's world? They should be at what? 20 or 30%. 20 or 30% in the market now. Now, remember, Jerry's making a point that 10% liquidity, 10% liquidity, 10% liquidity, that's awesome. Because what does this tell you to do? It tells you that you should have how much in the market right now? 20 or 30%. But then it tells you as time goes on, as you go through a 30-year retirement, what should happen? You should be what? Getting less and less in stocks or more and more stocks as time goes on? See, this is counterintuitive, but what we've been told forever, which is as you get older, you should put less and less in stocks. All the research that Foe and Kitces and these guys are the top of the game of research. And all the research says what? No, you should start out of retirement with low amount of money in stocks and then increase it towards it. So what are they saying here? They said that over 30 years, you should go from having 20 or 30% to 60 or 70. Well, if you think about that, let's start at 30. And then you took 10% out each decade, you'd end up with how much at the end of that? Not even, they're saying 10%, that's 1% movement of that per year going forward. How about 2% from the FIA into the market? How about you can do 5% from the FIA into the market? But where should you be happy right now? In the market or in FIAs? And then take money out of the FIAs and put it into the market? Or should you be instead putting all your money in the market and then decreasing that over time? So I'm giving you this information. Why? So this is not intuitive. You're going to have to walk through your clients with it. You don't want none of your money in stocks. You also don't want all of your money in stocks. You want to be right here. Start out with a low percentage and then over time take money out of the FIA and invest in the market if they want to do that. That's how you serve your clients best. So where do you find this chart, guys? Where is this chart? This is a slide that you all have available to you. This is a slide you have all available to you. It's in our FIA presentation for bonds. Do you think right now would be a great time to walk through this with your clients, this chart with your clients? What's this saying about you if you walk through your clients with this chart right now? That you get what's going on, that you've done your research, or you're just winging it and saying, hey, don't worry, when things will always get better. Do clients want somebody who's on top of their game? Does this chart show you that you're on top of your game? Yes, it does. Because guys, do you really want to be talking to your clients after, let's say, 17 months and the market's still down, 22 months and the market's still trying to recover, 48 months, 49 months? Is that when you want to be talking to your clients? Because it ain't going to be a 2 month, it ain't going to be a 3 month. The vast majority of these are going to be 17 months and more. If you had gone over this with them early on, what are they going to think about you at the end of that 17 months, 22 months, 28 months, or 49 months? That you did your job up front? Or why'd they even have you as an advisor when really all you said is, hey, just hang in there? Could they have done that by themselves, guys? Can they just hang in there by themselves? Now, they probably can't because they need your support. But in their minds, do they think they could have held on by themselves? In their minds, they think they're what? Geniuses. I mean, they need your moral support to do the right thing. This is helping them do the right thing. So I apologize for, I know some of you get irritated that I constantly talk about the dangers of the market. But guys, how many, does the news tell them the dangers of the market? Are the talking heads on the news talking about the danger of the market? It's sad because all of these things I showed you, Morgan Stanley, look at all these people I talked about. These are all stock market. Goldman Sachs, Morgan Stanley, Oppenheimer. They're reporting in our Market Watch. That is not something that typically consumers read. They're reporting, Bank of America, they're reporting to us that the market's a dangerous place to be. But when they're on the news, what are they saying? When they're on the news, what are they saying? You should be in the market or not be in the market. In or out, do they say? Hold the course, that's right. Be in, buy. Now's a great time to buy. Buy in this. Because if they don't say that, what happens to them? What happens to Goldman Sachs, Bank of America, which is Merrill Lynch? What happens to them? If nobody's buying, they what? They lose assets. That's right, Mark. So, of course, to us, in the industry, they're saying, man, all those sucker retailers out there, man, we're waiting for all of them to get out and lose their shorts. Now, are they helping people get out so they don't lose their shorts, or what are they telling them to do? Buy. So it's our responsibility to help them, guys. So I'm trying to give you tools to get out there and help them. So I apologize for hammering on this, but if we don't do it, where else are they going to find this information? If we don't do it, what are they hearing? Please get out there. Have conversations with your clients. Make sense? Now is the time to do it. Super. Well, you guys have a fan. I appreciate your patience with me in covering this information yet again, but it's just so important, okay? You guys have a great rest of the week, and we'll talk to you all next Monday. Thanks, everybody.